February 3rd, 2026. While you were sleeping, something happened that most people completely missed. The Bank for International Settlements, the central bank for central banks, quietly released a report that should terrify anyone paying attention. They identified what they call critical stress indicators in 47 of the world's largest financial institutions. Not one or two, 47. That's 62% of systemically important banks showing the exact same warning signs that appeared 18 months before Lehman Brothers collapsed in 2008. And here's what should wake you up at night. The average person has no idea this is happening. They're checking their 401k, seeing numbers go up, and assuming everything's fine. But those numbers? They're built on the same foundation that crumbled in 1929, in 2000, in 2008. And if history has taught us anything, it's this. The people who survive crashes aren't the ones who see them coming. They're the ones who prepare before the warning signs become obvious. In the next 30 minutes, I'm going to show you something most financial experts won't tell you. Not because they don't know, but because the system doesn't want you to know. There are universal patterns that appear before every major financial collapse. And more importantly, there are specific actions, concrete steps you can take right now that have protected wealth through every crisis in modern history. This isn't about getting rich. This is about not getting destroyed. The pattern. You need to understand, let me show you something. Every major financial crash in the last 250 years has followed the same 5-stage pattern. Not similar, identical. And right now in February 2026, we're sitting in stage 4. Let me walk you through it. Stage 1 is expansion. Credit becomes cheap. Everyone's borrowing. Stock markets are rising. Real estate prices are climbing. The economy feels unstoppable. Experts appear on television explaining why this time is different, why the old rules don't apply anymore. This stage typically lasts 5 to 8 years. We saw it from 1922 to 1929, from 1995 to 2000, from 2002 to 2007, and from 2010 to 2020. Stage 2 is acceleration. The expansion speeds up. Asset prices aren't just rising, they're soaring. People who were cautious start feeling stupid. Their neighbors are making money. Their co-workers are making money. Everyone's making money except them. So they jump in. This is when the last wave of buyers enters the market. Not the smart money, the desperate money. This stage typically lasts 12 to 24 months. In 1929, it was 1928 to 1929. In 2000, it was 1999 to March 2000. In 2008, it was 2006 to mid-2007. Stage 3 is the crack. Something breaks. Not the whole system, just one piece. A bank fails, a company defaults, a country can't pay its debts, the media reports it as isolated. An anomaly, nothing to worry about. But beneath the surface, panic is starting. Insiders are selling, smart money is exiting. The public? They're still buying the dip. The stage lasts 3 to 9 months. In 1929, the crack started in March with the first market decline. In 2000, it was the dot-com companies starting to fail in late 1999. In 2008, it was Bear Stearns collapsing in March 2008. Stage 4 is the cascade. This is where fear becomes panic. What looked like isolated problems reveal themselves as systemic. Banks that seemed safe are suddenly at risk. Companies that looked profitable are suddenly insolvent. The selling accelerates. Margin calls force liquidation. Algorithms amplify the decline. And the people who bought the dip, they're watching their wealth evaporate in real time. This stage lasts 6 to 18 months. In 1929, it was October 1929 to 1932. In 2000, it was March 2000 to October 2002. In 2008, it was September 2008 to March 2009. Stage 5 is the bottom. Absolute despair. No one trusts anything. Cash is king. Assets are trading for pennies on the dollar. And this is when the people who prepared make generational wealth, because they have capital when everyone else is desperate. Now, here's what you need to understand. In February 2026, we're in late stage 3, possibly early stage 4. The cracks are showing. In January 2026, 3 regional banks in the United States were placed under enhanced supervision by the Federal Reserve. The official reason? Commercial real estate exposure. The real reason? They're insolvent. In December 2025, the European Central Bank conducted what they called extraordinary liquidity operations for 14 European banks. Translation? Emergency loans to prevent collapse. In November 2025, China's property sector saw 23 major developers default on dollar-denominated bonds. That's $78 billion in defaults in 1 month. These aren't isolated incidents, these are cracks, and cracks become cascades. The question isn't whether a crash is coming. The question is whether you'll be one of the few who's prepared. The universal rules that never change. Here's what most people get wrong about surviving financial crashes. They think it's about prediction, about knowing the exact day the market will peak, about timing the collapse perfectly. That's impossible. Even the best analysts get timing wrong. What matters isn't prediction, it's preparation. And preparation follows universal rules that work in every crash, every time, regardless of the specific trigger. Rule number 1, real assets always outlast paper promises. In every crash, the same pattern plays out. Paper promises fail, government bonds default, currency loses value, corporate debt becomes worthless. But real assets, land, gold, commodities, productive businesses, they hold value. Not perfectly, not without decline, but they survive. Let me show you the data. In 1929, the stock market fell 89%, but agricultural land fell only 30%. In 2008, the S&P 500 fell 57%, but farmland fell 12%. In every hyperinflation, every currency collapse, from Weimar Germany to modern Venezuela, the people who owned physical assets, land they could farm, buildings they could rent, gold they could hold, they survived. The people holding paper? Destroyed. This isn't theory, this is pattern. In February 2026, look at what the data tells us. Global debt stands at $323 trillion. That's 342% of global GDP. Every dollar of that debt is a paper promise, a claim on future productivity. And future productivity is declining. Global growth forecasts for 2026 have been revised down to 2.1%. That means there's $323 trillion in claims on an economy that's producing less. The math doesn't work. Some of those claims will default. The question is which ones? Government bonds? Possibly. Corporate debt? Probably. Bank deposits? Potentially. But physical land? Physical gold? Productive real estate? Those aren't claims on the future. They're real now, today. Rule number 2, liquidity is survival. In every crash, liquidity disappears. Markets that were liquid become illiquid. Assets that could be sold instantly become impossible to sell at any price. And the people who survive are the ones who have access to cash when everyone else is frozen. Here's what this means practically. You need multiple layers of liquidity. First layer, physical cash. Not in a bank, in your possession. Enough to cover 3 to 6 months of expenses. Why? Because when crashes happen, banks limit withdrawals. ATMs stop working, credit cards get declined. You need cash to function. Second layer, liquid assets you can convert to cash quickly. Money market funds, short-term treasuries, gold coins you can sell locally. These aren't investments, they're insurance. Third layer, credit access before you need it, lines of credit, home equity lines, access to borrowing when banks are still lending. Because once the crash starts, banks stop lending. The people with pre-approved credit can borrow when everyone else can't. Let me give you a real example. In March 2020, during the COVID crash, bank lending froze for 6 weeks. If you needed capital, you couldn't get it. Unless you had a line of credit established before the crisis, those people could borrow at 4% while everyone else was locked out. In 2008, it was worse. Banks stopped lending for 6 months. The companies and individuals with pre-crisis credit lines survived. Everyone else, forced to sell assets at terrible prices just to get liquidity. Rule number 3, diversification isn't about asset classes. It's about jurisdiction and counterparty. Most people think diversification means owning stocks, bonds, and real estate. That's not diversification. That's concentration in one system. Real diversification is about spreading risk across jurisdictions and counterparties. Let me explain. If all your assets are in one country, one bank, one currency, you have single point failure risk. If that country's currency collapses, you're destroyed. If that bank fails, you're destroyed. If that system breaks, you're destroyed. Real diversification looks like this. Assets in multiple currencies. Dollars, euros, Swiss francs, Singapore dollars. Not because you're not speculating on currency moves. Because you're protecting against single currency failure. Assets in multiple jurisdictions. Some in your home country, some abroad. Ideally in countries with strong rule of law and property rights. Switzerland, Singapore, New Zealand. Assets with multiple counterparties, multiple banks, multiple brokerages, multiple institutions. So if one fails, you're not wiped out. This sounds complicated, but it's not. You can open a bank account in a foreign country. You can buy foreign real estate through REITs. You can hold gold in allocated storage in Switzerland or Singapore. The key is removing single points of failure. The specific actions that protect wealth. Now, let's get practical. Specific actions you can take right now. Not theory, not philosophy. Concrete steps based on what worked in previous crashes. Action 1, build a cash buffer outside the banking system. I'm talking about physical currency, not in a safe deposit box at a bank, in a safe at home or in private storage you control. How much? At minimum, 3 months of expenses, ideally 6 months. Why so much? Because in every crash, there's a period where normal financial infrastructure doesn't work. In 2008, there were bank runs. ATMs limited withdrawals to $300 per day. Credit cards were declined even for people with perfect credit. In Greece, in 2015, banks closed for 3 weeks. Capital controls limited withdrawals to $60 per day. If you had cash outside the system, you could function. If you didn't, you were dependent on whatever the system allowed. Physical cash also gives you optionality. When everyone else is forced to sell assets because they can't access money, you can buy those assets at distressed prices. Action 2, allocate 10-15% of liquid wealth to physical gold. Not gold ETFs, not gold mining stocks. Physical gold that you can hold or that's an allocated storage you control. Why gold? Because for 5,000 years, through every empire collapse, every currency failure, every financial crisis, gold has maintained value. Not because it's magical, because it's scarce, portable, universally recognized, and impossible to counterfeit. In 1929, gold was fixed at $20.67 per ounce. By 1934, it was revalued to $35, a 69% gain while everything else collapsed. In 2008, gold started at $800 and hit $1,800 by 2011, a 137% gain while stocks were recovering from a 57% loss. From 2020 to 2024, gold went from $1,500 to $2,800. In February 2026, gold is trading around $2,400. That's pullback from the 2024 highs, which means it's on sale. If the pattern holds, if we're entering stage 4 of a crash cycle, gold will likely reach $3,500 to $4,500 in the next 18 to 24 months. Not guaranteed, but historically probable. Action 3, pay down high interest debt immediately. Credit cards, personal loans, anything above 8% interest. Why? Because in a crash, income becomes uncertain. If you lose your job, if your business fails, if your investments collapse, the last thing you want is debt payments. You can't afford. High interest debt is a ticking time bomb. It compounds against you. Pay it off now while you have income. The mathematical return is better than almost any investment. If you pay off a credit card charging 22% interest, that's a guaranteed 22% return. You can't get that anywhere else risk-free. Action 4, accumulate skills that produce value in any economy. This is the most overlooked form of wealth protection. In a crash, financial assets can evaporate, but skills can't be taken from you. What skills matter? Anything that produces something people need. Farming, carpentry, plumbing, electrical work, medical skills, mechanical repair, cooking. These aren't glamorous, but they're valuable when systems break down. In every collapse, the people who could produce food, fix things, provide services, they survived and often thrived. Because production always has value. Paper wealth can disappear, but the ability to grow food, fix a broken pipe, or repair machinery, that's permanent wealth. Action 5, build redundancy in critical systems: food, water, energy, communication. Most people are completely dependent on just-in-time systems. They have 3 days of food in their house, they depend on municipal water, they assume power stays on, they rely on internet for everything. That's fine until systems fail. And in crashes, systems fail. In 2008, it was financial systems. In 2020, it was supply chains. The next crash could disrupt any or all of these. Building redundancy doesn't mean becoming a survivalist. It means having 30 days of food you actually eat and rotate through. Having water filtration capability, having backup power, even just solar panels and a battery. Having offline communication methods, having cash. This isn't paranoia. It's recognizing that complex systems are fragile. The psychological trap that destroys wealth. Here's what most people don't understand about crashes. The destruction of wealth isn't primarily financial, it's psychological. The pattern is always the same. People see assets falling and they panic. They sell at the bottom. Then they watch those same assets recover and feel stupid. So the next time, they hold on. They refuse to sell. And they ride the next crash all the way down. Both responses destroy wealth. The problem isn't the crash. It's the emotional reaction to the crash. Let me show you how this plays out. Stage 1 of the psychology is denial. The market falls 10%. People tell themselves it's a correction, it's healthy, it's a buying opportunity. They hold or even buy more. Stage 2 is hope. The market falls 20%. Now it hurts, but people hope it will recover. They hope because they need it to recover. Their retirement depends on it, so they hold. Stage 3 is fear. The market falls 35%. Now real fear sets in, but they're paralyzed. They don't know what to do. Should they sell and lock in losses? Should they hold and hope? They freeze. Stage 4 is panic. The market falls 50%. They can't take it anymore. They sell everything. At the bottom, right before the recovery, stage 5 is regret. The market recovers 30% from the bottom. They're sitting in cash. They miss the recovery. They feel stupid. And they swear next time they'll be smarter. But next time, they make the same mistakes. This psychological cycle has repeated in every crash for 300 years. And it always destroys wealth. Because buying high and selling low is the perfect wealth destruction strategy. So how do you break the cycle? The answer is to remove emotion entirely. You do this through rules, pre-commitment devices that you establish before the crisis, when you're thinking clearly. Here's what this looks like. Rule 1, set rebalancing triggers. Decide now that if the stock market falls 20% from its high, you'll reduce equity exposure by 25%. If it falls 40%, you'll reduce another 25%. This isn't market timing, it's automated risk management. Rule 2, set buying triggers. Decide now that if the market falls 50%, you'll deploy 50% of your cash reserves. If it falls 60%, you'll deploy the rest. This forces you to buy when everyone else is panicking. Rule 3, never sell in the first 30 days of a crash. Panic selling in the first month almost always locks in unnecessary losses. If you're going to sell, wait 30 days. This delay allows emotion to settle and prevents the worst timing. Rule 4, ignore portfolio values during crashes. Don't check. Don't look. Set a date 6 months in the future when you'll review. Checking daily during a crash only creates emotional volatility that leads to bad decisions. These rules work because they remove the psychological component. You're not making decisions in the moment. You're following a plan established when you were rational. The international dimension. Now let's talk about something most people completely ignore. Geographic diversification. Here's why this matters. In February 2026, if you're American, all your assets are likely in dollars, in US banks, in US property, and US stocks. That's not diversification. That's maximum concentration in one system. If the US dollar loses value, your wealth loses value. If US banks fail, your money is at risk. If US property crashes, you're exposed. This isn't anti-American. It's risk management. The same logic applies to every country. So what's the solution? You need to distribute assets across multiple systems. Here's how you do it. First, foreign currency accounts. You can open bank accounts in foreign currencies without leaving your country. Interactive Brokers allows multi-currency accounts. You can hold Swiss francs, Singapore dollars, Norwegian kroner. This protects against dollar devaluation. Second, foreign real estate. You don't need to physically move. You can buy international real estate through REITs or direct ownership. Property in Switzerland, Singapore, or New Zealand isn't correlated to US property. If US real estate crashes, Swiss real estate might not. Third, foreign precious metals storage. Store gold outside your home country. Allocated storage in Switzerland or Singapore means your gold is outside the jurisdiction of your home government. If capital controls are implemented, if confiscation becomes policy, your gold is protected. This sounds extreme, but it's exactly what wealthy families do. The Rothschilds have assets in 40 countries. The Rockefellers have trusts in multiple jurisdictions. They understand geographic diversification. You can implement this at any wealth level. Even with $50,000, you can have a foreign currency account, own international rates, and store gold abroad. The real estate trap. Let me address something specific because it's going to be relevant very soon. Real estate. In February 2026, US residential real estate is still elevated. The median home price is approximately $415,000. The median household income is $78,000. That's a ratio of 5.3 to 1. Historically sustainable ratios are 3 to 1. At 5.3, housing is roughly 77% overvalued relative to incomes. Commercial real estate is worse. Office buildings are 40 of ours 50% vacant due to remote work becoming permanent. Those buildings were financed with mortgages at 3% interest. Those mortgages are maturing now and must be refinanced at 7 to 8%. The math doesn't work. Owners are walking away. Banks are taking losses. And this is spreading. According to recent analysis, approximately $2.1 trillion. And commercial mortgages mature between 2025 and 2027. Industry estimates suggest 35% may default. That's $525 billion to $735 billion in potential losses. Who holds these mortgages? Regional banks. When they recognize losses, capital gets depleted. When capital falls below minimums, regulators shut them down. We've already seen 3 bank failures in January 2026 related to commercial real estate. More are coming. So what does this mean for you? If you own commercial real estate, consider your exposure. If you're heavily invested in commercial REITs, understand the risk. If you have deposits in regional banks with high commercial real estate exposure, consider diversifying to larger institutions or spreading deposits across multiple banks. This isn't saying sell everything. It's saying understand the risk and position accordingly. The currency dimension. Let's talk about something that will affect everyone, but that most people don't think about. Currency devaluation. The US dollar has lost approximately 98% of its purchasing power. Since 1913, what cost $1 in 1913 costs about $32 today. That's not capitalism, that's monetary debasement, and it's accelerating. Since 2020, according to Federal Reserve data, M2 money supply increased by approximately $6.3 trillion. That's a 41% increase in 4 years. More dollars chasing the same goods means each dollar is worth less. You feel this as inflation. But it's really devaluation. Your savings are being confiscated slowly through currency destruction. This matters because in a crash, governments print money to prevent collapse. They did it in 2008. They did it in 2020. They'll do it again in the next crisis. And every time they print, your dollars lose value. So how do you protect against this? You need assets that benefit from currency devaluation. Gold is one. It rises when currency falls. Foreign currencies are another. If the dollar is being debased, hold euros or Swiss francs. Real assets are the third. Land, property, commodities. These maintain value even as currency falls. The key insight is this: saving in dollars is not saving. It's slow motion wealth destruction. Real saving requires holding assets that preserve purchasing power across time. The final warning. Let me bring this together. We're in late stage 3, possibly early stage 4 of a crash cycle. The warning signs are everywhere. Bank stress indicators, commercial real estate defaults, corporate debt at record levels, government debt unsustainable. These aren't predictions. These are observations based on published data. The crash might start tomorrow. It might start in 6 months. It might start in 18 months. The timing is unknowable, but the pattern is consistent. And the pattern says, prepare now. Here's your action checklist. 1, build 3 to 6 months cash outside banks. 2, allocate 10 to 15% to physical gold. 3, pay off high interest debt. 4, diversify across currencies and jurisdictions. 5, accumulate valuable skills. 6, establish credit lines before you need them. 7, set psychological rules for crash behavior. 8, understand your real estate exposure. 9, protect against currency devaluation. These aren't complicated. They don't require expertise. They just require action. And the window for action is closing. Because once the cascade starts, once stage 4 begins, these actions become expensive or impossible. Gold will be twice the price. Foreign accounts will face restrictions. Credit will disappear. Cash will be rationed. The people who survive crashes aren't lucky. They're prepared. They recognized the pattern before it became obvious. They acted while everyone else was complacent. They positioned themselves for what was coming instead of hoping it wouldn't. You still have that choice. The pattern is visible. The data is available. The actions are clear. The question is whether you'll act or whether you'll wait until everyone else sees what you see now. By then, it's too late. If this analysis showed you something you didn't see before, share it. Because the people who survive crashes often do so because someone warned them early. History doesn't repeat exactly, but the patterns are consistent. And right now, the pattern is screaming a warning. The choice is yours.